Hello students, welcome to all of you Shiksha 360 Jab classes. Today we have to cover the chapter number 34 part 2. Chapter number 34 part 2, that is regarding the marginal costing. Clear? So in this session, first of all we have to discuss regarding the break-even analysis. After that we have to discuss the margin of safety. Third point which we have to discuss here, that is the absorption cost. Okay, so all these points we have to be covered here one by one. So let's start our discussion on the basis of all that. So first of all, which we have to discuss, that is the break-even analysis. So what it tells that the break-even analysis basically, which is a past part, clear, the break-even analysis basically, which is a part of the cost volume profit analysis. Also involves finding the correlation. Clear, basically this is also involves finding the correlation. Basically, what is the relation between the fixed cost, finding the correlation between the fixed cost, variable cost, sales revenue, and profit here. All these, between all these, they are to able to find the relationship between the fixed cost, variable cost, sales revenue, and profit. Further, whenever one unit of the product is going to be sold, whenever one unit of the product is going to be sold, it's a sale volume minus its variable cost provides a surplus. That is, they are talking about regarding the contribution here. They are talking regarding the contribution here, that is sales value minus variable cost. Clear? So whenever one unit of the product, clear? So whenever basically one unit of the product it is going to be sold here, it's a sale value minus its variable cost provides a surplus which goes towards meeting the fixed expenses. Clear? This is a surplus. This is to be known as the surplus here. That is contribution. Here in the case of the marginal costing, basically this helps in meeting the fixed expenses. Clear? Basically this helps in meeting the fixed expenses. Clear? Later on we are able to understand basically this fixed expenses, it is also to be included in the cost of the product. Clear? That will be also included in the cost of the product, and that costing, it is to be known as the absorption costing. Clear? That costing basically it is to be known as the absorption costing here. Okay, so break even level, it is that activity level at which all relevant fixed costs are to be recovered and there is no profit or no loss. Clear? So basically just you have to remember that at the break even point there is no profit or to be no loss here. Clear? There is no profit and no loss in the case of the break even point to be here. Further, for activity level, clear, that is for the activity level below the break even level, the company will make losses. Clear? Basically if they are below the break even level, so in that case the company basically will make the losses, and while above this level it will make the profit. Clear? While above this level basically it will make the profit, and below this level it will make the losses to be here. Okay, so kindly remember both the points to be here. Now move to the next one. Now let's understand basically this thing with the help of one example here. So what they are going to tell in this example, so a company manufacturing LED bulbs. Clear? So here what they are telling, that a company basically manufacturing LED bulbs has the following financial information. Total fixed cost 2 lakh. Sales price per bulb, that is rupees 60. Cost of all direct inputs like material, labor, etc., utilities, it is to be rupees 40. So this is the sales price. This is the cost of all direct inputs like material, labor, utilities, etc. It is to be rupees 40. So now here basically we have to calculate the break-even level. Clear? Which we have already calculated in the previous session. Okay, this thing we have already calculated. Now in this session, first of all, we have to analyze this one. In the previous session, we have not analyzed this break-even analysis. Now here we have to first analyze this break-even level. So how we have to analyze here, let's understand. So the break-even point can be expressed in any of the following ways. Clear? So how we can able to understand the break-even point? So break-even point here can be expressed in any of the following ways. First one, that is in the number of the units. Example, in the above illustration, the break-even point basically it is 10,000 units. Clear? If the sale is going to be more than 10,000 or less than 10,000. Clear? If the sale it is going to be more than 10,000, so they are moving towards a profit, and if the sale is going to be less than 10,000, so they are moving towards a loss here. Clear? So in that case, they are moving for the loss here. Okay, this is the first point which we have to cover here. Second one, in sales volume in the money terms. Clear? Second point which we have to cover here, that is, it is also the sales volume, but in the way of the money terms. Clear? Basically, in the way of the money terms to be here. Sales volume basically in the way of the money terms. So in the above illustration, the break-even point in the way of the sales volume, it is to be rupees 6 lakh. Clear? Because the cost of each bulb, it is to be rupees 60. And what is the quantity producing, that is 10,000. So overall the sales volume, clear, it is to be 6 lakh. Clear? So in the above illustration, the break-even point in the sales volume, it is to be rupees 6 lakh. Clear? That is to be rupees 6 lakh to be here. Now move to the next point. Clear? Now move to the next point here. In percentage capacity utilization. Clear? So how we have to calculate the percentage capacity utilization? So example, in the above illustration, if the total capacity, clear, in the above illustration, basically if the total capacity of the plant is to manufacture 20,000 bulbs per year, clear, the total capacity of the plant basically to manufacture is to manufacture 20,000 bulbs per year. So the break-even point in this case basically it has to be 50%, clear, because how much they are manufacturing here. So basically what is the break-even point, that is to be 10,000, clear. So that is to be 10,000. So 10,000 upon 20,000, that is to be 0.5 or 50% of the plant capacity, clear. So in that case basically capacity utilization in the basis of the percentage capacity utilization, basically it is to be 50% of the plant capacity, clear. That is to be basically 50% of the plant capacity here. Okay, so this is the break-even analysis. Hope all of you are able to understand here. Now we have to move to the next point here. Application of the break-even analysis or the cost volume analysis. Just you can go through that. There is nothing any typical. Now we have to check out profit volume ratio and its significance. Clear? PV ratio, very, very important. PV ratio and its significance. So here that is the profit volume ratio, also known as the PV ratio. Basically, it is a very important concept in the marginal costing. What it tells, it represents the ratio of each unit contribution to its sales price. So what it tells, that basically it tells the each unit contribution. Profit, basically what is that? Profit basically it is to be, that is contribution. Okay, so it represents the ratio of each unit's contribution to its sales price, and it is expressed in the percentage terms. So if C is the contribution and S is the sales price per unit, so how we can calculate PV ratio? Clear? C is the contribution and S here it is to be the sales price. So what is the PV ratio here? That is C upon S into 100. This is to be the PV ratio, that is C upon S into 100. This comes out to be the PV ratio here. Okay. So now on the basis of that, we have to discuss some of the numericals here. For example, if the unit sales price SP, it is to be rupees 160 and variable cost, it is to be rupees 120. Clear? If the unit sale price, it is to be rupees 160 and the variable cost price, it is to be rupees 60 here. So then what will be the PV ratio? Clear? So in that case, what will be the PV ratio, or we have to calculate the PV ratio in this case. So PV ratio, that is contribution upon SP into 100. So what is the contribution here? That is 160 minus 120, that is to be rupees 40 upon 160 into 100. 1, 4, 1. So 25% here it is to the PV ratio. So that is 160 minus 120 upon 160 into 100, because the contribution of each unit is 40 rupees. So 40 upon 160 into 100, that is to be 25%. Clear? Significance of PV ratio here. Clear? So now let's understand what is the significance of PV ratio. So in a multi-product company, the PV ratio of different products. Clear? So in a multi-product company, basically the PV ratio of the different products here basically will gives us a clear idea. Clear? Basically that will give us a clear idea of profitability of each of the product. Clear? Gives a clear idea of the profitability of each product. With the further analysis, we can able to understand that is this can be used by the management. Clear? So with further analysis, this can be used by the management to decide about the pushing the sales of certain products. Clear? With further analysis, this can be used by the management to decide about pushing the sales of the certain products or repricing certain other products. Further, it is also helpful in decided whether to purchase the certain components specifically from outside or continue their in-house production. Clear? All these things we are able to understand basically with the help of the PV ratio. Okay. That is pushing the sales. Clear? Basically, if we are getting more profit from that, so basically it is beneficial for us to increase the sales for certain products. Clear? So it depends upon case to case, depends upon product to product here. Next one, that is the margin of safety. Clear? Sometimes basically we can say that our sales is going not to be up to the mark. Clear? So in that case, we are going with some margin of the safety. Clear? That is in the case of the loss. Clear? That is we will not face the loss here. Clear? That is there will be margin for that also. Clear? So what is the meaning of that and how we have to understand all these things? Let's discuss it. So every business here, that is every business basically it is exposed to the uncertainties of the market competition, unexpected disruptions in the supply chain. Clear? Sometimes mishappening will happen. Or production. Clear? Unexpected disruptions in the supply chain or production. Disruptions and lockdowns of the marketing channel due to the strikes or pandemics, etc. Okay. So all these are uncertainties in the business. So therefore, in practice, achieving the estimate or budgeted production. Clear? So therefore, in practice, achieving the estimate or budgeted production and sales level may be difficult. Clear? So achieving the estimated or budgeted production or sales level very difficult. Clear? Because if we are not getting sufficient support from the production or the supply chain, so in that case, some disruption, it is part of the normal risk faced by the business in general. But if that business declines below a level, clear, some risk it is to be continuously going on. Clear? Or ups and down, it is continuously to be going on. Clear? But if it is going on above the limit, clear. But if the business declines below a level where there is a loss, so such a situation, clear, if the business declines below a level where there is a loss, so such a situation cannot be sustained for a long period. Clear? So in that case, such a situation basically cannot be sustained for a long period. So as we have seen above this level, it is to be indicated by the break-even level. Clear? So how we are able to understand this case? This is to be understood with the help of the break-even level here. Clear? So this can be understood with the help of the break-even level. Clear? That is, if the sale is above the break-even level, we are moving toward the profit. Below, basically, we are moving toward the loss here. Now, next one. So the gap between the estimated, clear, the gap between the estimated or the budgeted level of operations and the break-even level. Clear? So the gap, basically, there is a gap between the estimated or budgeted level of operations and the break-even level. Basically, indicates the caution available to the business for sustaining its operation. Clear? Indicates the caution basically available to the business for sustaining its operations in times of adversity. Clear? Basically, for sustaining its operation in the times of adversity. So that is to be referred as the margin of safety. Clear? So what it is to be referred? That is just to be referred as the margin of safety. Further, that is, it is expressed in the percentage terms. So how we can refer the margin of safety? Basically, what is that? It is a difference and the break-even level. So margin of safety, that is estimated sales minus break-even sales upon estimated sales into 100. Clear? So this is the answer here. So margins upon estimated sales into 100, that is to be known as the margin of safety here. So now let's discuss this thing with the help of one example here. So like here, one example, if the estimated sales of a company during the year, estimated sale, it is to be 110 lakh. and break even sales, it is to be 70 lakh. So what is the sales minus break even sales upon estimated sales into 100? This is the formula. So 110 minus 70 upon 70 into 110. It is to be 40 upon 70 into 110. 400 upon 7. Sorry. Upon 110, I am writing 70. Sorry. So 40 upon 110 into 100. It is to be 400 upon. Okay. So that is to be margin of safety here. Hope all of you are able to understand. Just simple remember that margin of safety, what is that? Estimated sales minus break-even sales upon estimated sales into 100. That is to be the margin of safety here. Now, after that, we will move towards the next point here. Absorption costing. Clear? I have also tell you in the starting of the discussion. Absorption costing basically it is that type of costing in which we include the fixed cost also while deciding the price of the product. Clear? Basically in which we include the fixed cost also while deciding the price of the product. Clear? So let's under this discuss further. So under the marginal costing, only the variable cost. Clear? Under the marginal costing, we already know that only the variable cost we use here. Clear? Under the marginal costing, basically only the variable cost basically that is to be allocated to a product. So the cost of a finished unit in inventory will include only the direct materials, direct labor, and variable overheads. Clear? And variable overhead cost. It will not include the fixed overhead cost in the marginal costing, which are directly taken to the profit and loss account. But what will happen in the absorption costing? In the absorption costing, these fixed overhead costs, clear, in the absorption costing, these fixed overhead costs are also allocated to the product in addition to the variable cost. Clear? So in absorption costing, basically, these fixed overhead costs, clear, these fixed overhead costs are also allocated. Clear? These fixed overhead costs basically are also allocated to the product. Clear? To the product in addition to the variable cost. Is clear? In addition to the variable costing. So thus the absorption costing, it is also called as the full costing or the full absorption costing. Clear? So in that case, basically thus therefore the absorption costing, it is also called the full costing or the full absorption costing. Further absorption costing basically it is needed. Clear? Absorption costing basically it is needed for external financial reporting and for the income tax reporting purposes. Clear? So basically where it will be utilized. Clear? Sometime in the examination they will ask where it will be utilized. So absorption costing it is needed for the external financial reporting and for the income tax reporting purposes, while the marginal costing it is to be maintained. Clear? While the marginal costing basically it is to be mainly useful to the management for decision making, and outsiders basically may not have much interested in it. Clear? So in the marginal costing basically that is used by the management for the decision making, and absorption costing basically that is used for the external financial reporting and for the income tax reporting purposes. Clear? And for the income tax reporting purposes. So how it will impact the cost of the product? So now let's understand how it will impact the cost of the product here. So this can be understood with the help of one example. So here that is a company manufacturing LED bulbs. Same example, clear? Same example we have to take a fixed overhead cost here that is to be rupees 1,50,000. Cost of all indirect inputs like material, labor, utilities per bulb. So this one it is the cost that is 40 rupees. Variable overhead cost that is to be rupees 60,000. Total bulb produced that is 15,000. So variable cost, variable overhead cost per bulb. Variable overhead cost per bulb it is to be how much it is to be there. Total variable cost per number of bulbs. It is to be 4. So 40 plus 4. 44. This is the marginal costing. Clear? As with the way of the marginal costing, this is the price of one bulb that is rupees 44. Clear? But in the case of the absorption costing, clear? But in the case of the absorption costing, we have to include the fixed overhead cost also. Clear? So what is the fixed overhead cost per bulb? So 1,50,000 upon 15,000. So that is to be 10. Clear? So as per the absorption costing, what is the price of one bulb? 44 plus 10, it is to be 54 rupees. Clear? So as the price of the As the price basically in the absorption costing, it is to be rupees 54, and in the case of the marginal costing, it is to be rupees 44. Clear? So this is the difference between the two types of the costing here. Same thing they are mentioning here. Clear? So under the marginal costing here, the cost allocated to the each bulb are only the variable cost, that is 40 plus this one 60,000 upon 15,000, that is 44. The fixed overhead cost basically are not included under the product cost here. Further, under the absorption costing, in addition to the variable cost of rupees 44 bulb, clear, in absorption costing basically in addition to the variable cost of rupees 50 rupees 44 per bulb, the fixed overhead cost, that is rupees 1,50,000, basically it is also allocated on the pro rata basis. Clear? That is to be also allocated on the pro rata basis, that is 1,50,000 upon 50,000, that is rupees 10 per bulb. So the total cost of each bulb, clear? So the total cost basically of each bulb under the absorption costing, it is to be rupees 54 per bulb. Clear? That is to be rupees 54 per bulb. Clear? So hope all of you are able to understand regarding all these points regarding the marginal costing here, absorption costing here, and what are the different types of question they will ask on that. Break even analysis we have also discussed here, margin of safety we have also discussed here. Okay, all the points we have to be discussed here. Now last 2 points which we have to cover, that is what is the effect on stock valuation. There, what is the impact on the stock valuation? As we have seen above, in absorption costing, the fixed overhead costs are also allocated to the product in addition to the variable cost. The fixed cost basically it is to be also included under the absorption costing. So therefore, the cost allocated to each unit of the product under the absorption costing basically will be more than that under the marginal costing. Clear? So that is the general thing basically which we have also analyzed, that is there will be the more cost. Clear? So therefore the cost allocated to each unit of the product under the absorption costing basically will be more than that under the marginal costing. Clear? So this will result in higher valuation of the finished goods under the absorption costing than under the marginal costing. Clear? So this will result in higher valuation of the finished goods under the absorption costing than that under the marginal costing. Further, if there is no change, clear, further, that is if there is no change in the inventory of the finished goods during the year, so it will make no difference in the valuation of stocks whether we use the marginal costing or the absorption costing. Clear? That is if there will be no change in the inventory of the finished goods, clear, during the year, so it will make no difference. Clear? That is, it will make no difference in the valuation of the stock whether we use the marginal costing or the absorption costing. Clear? Basically, if there will be change, so absorption costing basically will be little bit higher. Okay, because in that we will include the fixed cost. So next one, that is the last point, that is effect on profit. Clear? Effect on profit. So as the valuation of the finished goods under the absorption costing, it is higher than the marginal costing. So if inventories increase during a period, clear, if inventories or stock increase during a period, higher profit will be shown under the absorption costing than the margin costing. When inventories decrease, less profits are shown because under the absorption costing, closing finished goods is valued at the higher figures. Clear? Because there will be higher stock will be left in our hands. Clear? So when the inventory is decreased, clear. So it depends upon the inventory also. Clear? Basically, if there is inventory increase, that is we are selling more, so that is higher profit basically will be shown under the absorption costing than the margin costing, because under the absorption costing we are also taking the fixed cost basically from the customer. So this is the point you have to be remember here. So the difference in the profit here, basically it is due to the difference in accounting. Clear? So the difference in the profit here, that is it is due to the difference in accounting for the fixed overhead cost for valuation of the finished goods. Clear? So the difference in the profit, it is due to the difference in accounting for fixed overhead cost for the valuation of the finished goods. So when the entire stock purchased during the year it is sold, there will be no change in the inventory of the finished goods, and so the profit revealed by both the methods will be same. But when the sales and production are not same, so the difference in profit basically will be shown in the profit and loss account. Clear? So just one thing you have to remember, that basically if there is any change in the inventory, so basically it will impact that. If there is not any change in the inventory, clear, basically when the profit and sales, or there is no change in the inventory of the goods, so the profit revealed by both the method will be same here. But when the sales and production are not to be same here, clear, just you have to refer the examples what we have covered. Difference in profit basically will be shown in the profit and loss account. Clear? So in that case, Difference basically will be shown in the profit and loss account. Clear? So this leads to the completion of the marginal costing here. And I request to all of you kindly go through the two videos, basically what we have covered in detail, all these points, and slides are already available in the group. Refer to that also. Clear? After that, I will discuss some of the MCQs in the group for the practice purpose. So thanks to all of you for joining this session. It leads to the completion of chapter number 33, 34, 35. Clear? Standard costing, marginal costing, budget, and budgetary control. Clear? So please do revise all these chapters. So thanks to all of you for joining this discussion.